Every fraud on this list is underneath the exact same trick. Every fraud on this list is underneath the same trick. A company reports money that is not there or hides money that is, and for a while the numbers hold. Auditors sign them. Investors believe them. The share price climbs on figures that describe nothing real. What follows is 8 of the largest accounting frauds ever run, in order of how they worked, what each one faked, the number it turned on, and the moment the fiction met the balance sheet. Not a single one was undone by the market. In every case, the machine kept running until one person, an auditor who would not sign, a journalist, a short seller betting the other way, checked whether the money existed and found that it did not. That is the whole pattern. The rest is scale. Wirecard was a German payments company and one of the country's most celebrated technology stocks. Its books showed 1.9 billion euros sitting in trust accounts at banks in the Philippines, about a quarter of its assets. The problem was that the cash was not there. For years, the balances were propped up with forged documents, while a Financial Times investigation said the profits behind them were invented. In 2020, the auditor refused to sign off the 2019 accounts because it could not confirm the 1.9 billion euros existed. A few days later, the company admitted it. In its own words, the bank trust account balances in the amount of 1.9 billion EUR do not exist. On the 25th June 2020, Wirecard filed for insolvency, and its chief executive was arrested. The regulator that was supposed to catch it had instead spent years investigating the journalists. The full breakdown of Wirecard is on the channel. Enron came apart first and set the template. The energy trader used a method called mark to market to book years of future profit the moment a deal was signed, and it parked its losses and debt in a web of special-purpose entities run by its own finance chief. On paper, it was one of the most admired companies in America. Then a short seller and a magazine reporter began asking why the numbers did not add up. In October, the company disclosed a $18 million loss and a $1.2 billion cut to shareholder equity. On the 2 December 2001, Enron filed the largest corporate bankruptcy in U.S. history at the time, $63.4 billion in assets. Its shareholders lost $74 billion. Its auditor, Arthur Andersen, was caught shredding documents and did not survive. The full breakdown of Enron is on the channel. Theranos sold a machine, not a balance sheet, but the fraud was the same shape. Founded in 2003 by a 19-year-old, it claimed its Edison device could run hundreds of tests from a single drop of blood. It raised more than $700 million and reached a $9 billion valuation at its peak in 2013 and 2014. The company was secretly running the samples on modified commercial analyzers made by other firms. The number that described a revolution described a normal blood testing company. In October 2015, a Wall Street Journal reporter revealed what the machines actually were. By June 2016, one estimate put the founder's personal net worth at nothing, down from $4.5 billion. In March 2018, financial regulators charged her with fraud. The full breakdown of Theranos is on the channel. Parmalat was an Italian dairy giant, the maker of long-life milk sold around the world. Its accounts showed billions in cash it did not have, ensured by a single forged document, a letter claiming 395 billion euros sat in account at Bank of America, held through an offshore vehicle in the Cayman Islands. In December 2003, the company could not find the cash to pay its bondholders. Bank of America then said the document was a forgery. The account did not exist. The company collapsed in 2003 with 14 billion euros of debt, and the administrators later put the true figure at 14 billion euros, almost 8 times what had been reported. It remains Europe's biggest bankruptcy. Its auditor and its market regulator were both drawn into the case. The full breakdown of Parmalat is on the channel. Steinhoff was a global retailer, listed in Frankfurt and Johannesburg. For close to a decade, it booked fictitious and irregular transactions with parties it secretly controlled, so that income and asset values it reported were partly invented. The auditor Deloitte uncovered the irregularities during the 2017 audit. In December 2017, the chief executive resigned, and a forensic investigation by PwC followed. That investigation found that between 2009 and 2017, more than 6.5 billion euros in fictitious transactions had passed through the group's books. The market reacted in hours. On the first day, the stock lost 58% in Frankfurt and 56% in Johannesburg. Within 2 weeks, almost 90%. By March 2019, it was still down 96% from where it had traded before the scandal, about $15 billion in market value gone. The full breakdown of Steinhoff is on the channel. And MC Health was a hospital operator listed in London, once in the FTSE 100. Its problem was debt it simply never showed anyone. The board had approved one set of numbers, the company had borrowed against another. In December 2019, a short seller published a report questioning the accounts. What followed was worse than the report. The board found it had reported debt of $2.1 billion when the real figure was around $5 billion, and later identified more than $2.7 billion in loans that had never been disclosed to it at all. By March 2020, the total was put at $6.6 billion. The regulator later ruled the company had understated its debts by as much as $4 billion. MMC went into administration in April 2020. The full breakdown of MC Health is on the channel. Greensill called itself a finance firm, but its core business was lending against receivables, invoices for sales that had not happened yet. It concentrated much of that lending in a single client group with an exposure of $5 billion and packaged the debt into funds that Credit Suisse sold to investors as low risk. The whole structure depended on insurance. In July 2020, insurers covering $4.6 billion of it said they would not renew. With the cover gone, the paper was worth far less than its label. On a 1 in March 2021, Credit Suisse froze $10 billion held in its supply chain funds, and days later Greensill filed for insolvency protection. The receivables that never existed took a global bank's reputation down with them. The full breakdown of Greensill is on the channel. Bre-X is the oldest fraud here, and the most physical. It was a Canadian mining company that claimed to have found one of the largest gold deposits in the world at a site in Indonesia. The trick was salting outside gold was sprinkled into the drill samples, so the assays showed a fortune that was not in the ground. At its peak in May 1996, the stock reached $286.50 a share and the company was worth more than 6 billion Canadian dollars. Then a mining major, doing its own drilling for due diligence, found almost nothing. In May 1997, an independent firm confirmed the samples had been tampered with. The company filed for bankruptcy protection that same year and investors lost an estimated $6 billion. There was no cash to hide here, only rock that was never there. The full breakdown of Bre-X is on the channel. There is one pattern under all 8. In each, the reported number was fiction. Cash that was not there, debt that was hidden, gold that did not exist. And in each, the fiction held right up until someone checked. It was never the market that caught them. It was an auditor who refused to sign, a journalist who kept asking, a short seller who bet the numbers were wrong. That is the lesson underneath all of it. Audited, listed, admired company can report a number that describes nothing at all, and the system can carry it for years. The channel has a full breakdown of each case. The mechanism, step by step. The filing is where the story starts.